Update podcast covering tax equity investments, and the title is Expanding the Use of Tax Credits. Welcome.
Thank you, Craig. Thanks for inviting me.
Hey, George, can you give our listeners a quick overview of the tax equity investment categories? What are those categories that we need to think about?
Yeah, so they're divided amongst a number of fashions. One is both federal, with respect to federal, and then with respect to state. So there's a dichotomy between the two. Within federal, we'll be discussing affordable housing or low-income housing, as is referred to in the tax world. We'll talk about renewable energy, and which could be either wind or solar. We'll talk about solar. And then finally, the last topic would be federal historic tax credits. What you'll also see on the state side is there's a variety of other, in addition to those three categories, there's a variety of other what I'll call real estate related opportunities, as well as opportunities to participate in film tax credits. So those are the kind of the broad ways to look at it. You first kind of bifurcate it between federal and state, and then within each of those, then there are their own different categories with their own nuances.
So the difference between tax credits that are offered either in the form of, like you said, movies or film, and historical buildings or housing, why are tax credits offered? What's the purpose of offering these either at the state or federal level?
Yeah, so good question, and we get it asked numerous times. And frankly, the tax credit environment represents a public-private partnership to address areas where private capital or the private marketplace is not throwing sufficient amount of capital and attention. The classic example I always go through with people is I'm 60. When I was growing up, there were a number of federal housing projects in my community where I was living, and these were always rundown areas. The federal government ran them. They all looked the same. They looked disgusting, and it was just a awful place to live. And as a result, people didn't take pride in them, and they were horribly run down. And there was crime and all the bad elements of the old housing projects. Today, what a tax equity tax credit will do into the environment is it will provide good developers with a capital incentive to produce a product that that's effectively equivalent to a market rate product, which is made available to people that need affordable housing. And instead of bringing property values down, these projects now bring property values up. They bring pride in their residents in terms of where they live, and they produce other resulting benefits, whether it's in terms of affordable housing, for example, for elderly or other groups that need assistance. And with it, they bring other benefits to the surrounding areas. The same can be said for renewable energy. Same can be said for historic renovation. Basically, most historic projects wouldn't be undertaken without these tax credits, for example, because it's cheaper to demolish a building and start over than it is to try to rehab it. So there needs to be some additional incentives for companies to go in and rehabilitate a project. Likewise, in renewable energy, it was determined that the private sector wasn't focusing enough, that the returns were not high enough for the developers, and so in order to get a sufficient amount of capital deployed for renewable energy, they introduced this credit which incentivized developers to build projects. It has the other side benefit is the federal government isn't picking winners or losers. It's simply creating incentives for a particular category of economic activity. And the good developers and the good sponsors will thrive, and the poor ones will not do as well, and they will not be able to continue long-term in that particular activity. So it's a nice way of mirroring a partnership between government and the private sector.
So this alignment of perspectives and incentives helps to achieve a governmental goal along with what a corporation may be trying to do.
We're trying to create a public good out there through the private sector wherever possible.
Now, tying those back to, we spent a little bit more time on the federal government or a state government purpose. Sure. How do these credits align with the corporate objectives? You would mention the return, a comparable return. How else might it align with what a corporation is trying to do?
There's two kinds of investors in these projects, and there's actually technically there's three overall. So the first one is what I'll call the sponsor/developer, and that's the person that's going to build the project and create the project. And then there's going to be another investor in the project, and that person's what we call the tax equity investor. And in that tax equity investor, what role do they serve? Well, there's a bunch of tax credits, let's just say, or attributes that are being produced by the project. But a developer sponsor can only use so many of these before they are of no further utility to them. Kind of like our president. Our president is a big real estate developer, does a lot of activities from a real estate perspective that generate tax benefits, and consequently, he doesn't pay any tax. Likewise, most developers in these areas that have tax incentives very rapidly no longer pay tax, and the incremental incentive they're being provided does them no additional benefit. So in order to get a project completed, what they do is they form a partnership whereby the second class of investors, the tax equity investor, would invest. And that tax equity investor would receive the bulk of the tax benefits from a particular project. And that tax equity investor could be anybody, but typically it's going to be a corporation, and they're motivated by a number of different things. Obviously, they're motivated by a financial return, but what's also motivating them is the current, what I guess call the current ESG initiatives that corporations are out there seeing. These investments represent potentially either very sound environmental benefits to the country if it's renewable energy, or the public, which a company that may have some sort of renewable energy initiative can have them fulfill. There are also what you would refer to as socially responsible investments, meaning they could be improve the environment. They could also represent sustainable energy for a company if that was an initiative. They could also represent urban renewal and the firm's contribution to urban renewal, or they could also be representing, in the case of affordable housing, they could represent an investment which is a giving back to the community, giving back to society in the form of contributing towards affordable housing, not just for the workers, but for everyone in the community. So for companies with these ESG initiatives, almost any tax equity investment will score points in that department, as well as it producing lower effective tax rates for the tax equity investor and higher after-tax GAAP earnings.
Yeah, so there's a financial incentive as well as I call it a good citizen reward for that. Plus, there could be local benefits too, removing a blight area, putting better housing in, helping the overall area. In terms of tax,
it's what you'll see in several of these deals too, where there's local advertising done, where the projects will say these projects made possible by the sponsor's developer as well as the tax equity investors. So there's many opportunities for positive PR from these investments in the local communities around the investments.
So let's move the conversation in the direction of tax credit examples. Now, you talked about tax equity investing and described some of that. And tax credits, I think you gave an example. You started giving an example on the film industry, or you mentioned that. Maybe you could talk through some examples, but also in the context of I know that some tax credits can be transferred, others cannot. Maybe you can explain that in conjunction with why would a state make a tax credit transferable and the value that brings or doesn't bring to an organization.
Okay, sure. There's really, I would describe it from a structural standpoint, three kinds of credits out there. So the first one is one that we won't be talking about any more than right now, which is what I call non-transferable credits. And those would be, you'll see often a state might issue a jobs training credit to a company to defray the cost of them spending money on a particular jobs training program for employees. And that credit is non-transferable in any fashion of the word and has to be used by the company that is qualifying for the credit because of the training work they do. And that's just a direct incentive to a company to perform a training for potential employees or possibly existing employees. That's one example. And then what you'll see is at the other end of the spectrum is you'll have what's called freely transferable credits, which a film credit is a classic example of that. And that's a credit that the state would award a company that earns the credit for one reason or the other. In some states, some R&D credits work this way as well as not just film credits. And the company has the ability to directly sell the credit to a taxpayer in that state or jurisdiction. So if the production company that is creating the credit doesn't owe tax in the state in which they're shooting, for example, Georgia, then they could turn around and sell that credit to another company that in fact is paying tax in Georgia and could use the credit. And so that's called a freely transferable or directly transferable credit, often referred to as a certificated credit because typically it will come with a certificate from the state saying, here's the value of the credit. And that's kind of the easiest to transfer because it can transferred directly from the entity that creates the credit to the company that wants to use it. And the third kind is one that's probably the most prevalent among all the tax credits out there. And that credit can be used by a third party, but to allocate it to an entity other than the entity that makes it, that party has to join into a partnership with the creator of the credit, and it can be allocated to that credit. Usually it could be freely allocable any way the partnership agreement says it can be allocated, and it's a pretty straightforward deal. And those allocations are simple partnership agreements. There's no further liability or exposure other than for the particular credits to that company that wants the credits, and you don't have to be a real investor in the underlying activity. You're just an investor to the extent of the credits. And so it's a little more complicated because it requires a partnership investment, but at the end of the day, it's really just an investment in the particular credit. And why does the developer need that investment? What happens is the developer takes that investment for the activity, and that's part of the capital stack that they use for either creating the solar energy, the affordable housing, or the historic renovation. So the capital contributed by the tax credit investor into the partnership is then used to build the project, or to complete the project, or to be the equity necessary to get permanent financing in. So I kind of said a mouthful there, but there you go.
Well, there's a lot of good information. So there's non-transferable, transferable, and allocable types of credits. So you had mentioned these are offered by state and the federal government. Are these common? Is the use of tax credits common outside of the U.S.?
There are some programs outside of the U.S., different kinds of incentive for renewable energy. For example, in Europe, you will see there are some countries have film credits, for example, as well. I know Bulgaria has one. Not that I've gone there to look at it, but there are places that have some of these kinds of incentives which can be transferred to corporations. So the concept isn't just a U.S. concept.
Yeah, so maybe I can ask you about the economics. So if there's a company that has tax either owed federally or perhaps within the area of credits. Let's say they're in Georgia. Both our companies are in Georgia. There are certainly a lot of studios being built. How would a company take advantage of that? What might that look like from an economic standpoint if they're going to acquire these transferable tax credits? What would that look like?
So that is really pretty simple, pretty straightforward proposition. A company such as a film production company typically they're not going to pay tax in the jurisdiction they're making a film. If you think about it, they don't have any revenues yet, so why would they don't have revenues until the film is completed and it has been marketed? And that marketing and post production process can take a full year before they start having revenues anywhere, let alone having revenues in Georgia. So they can't use the credit. What they will do is they will they will contact a firm such as ours and say, hey, we have X million of credits that we need to find a home for, somebody that can use them. Will you do that for us? We will say, sure. We'll locate a company that is paying tax in Georgia that would like to reduce their effective tax rate, and we'll end up selling them to that company for roughly, let's just say, I'll round here to 90 cents on the dollar. So a company would pay $90 to get $100 of film credits. It's done through a simple contract between the production company and the buying company. It's very simply that document is then there's a couple of simple documents that are then filed with the Georgia Department of Revenue. It's a very simple process, and then you report the buyer would then report the credits on their tax return. The seller would report the production of the credits on their tax return, and they would also indicate that they have sold the credits that they have produced. It's a very straightforward process. No particular issues out there. Often you will see the selling entity, at least when we're involved, they will guarantee the credits to the buyer. It's a pretty standard process. We've been involved with all of these credits actually since we started in 2004, and we've never had an acquirer of a credit lose a credit. So it's a very safe process, I would say. And in many of these groups of credits or kinds of credits, there are many kinds of these credits where no one in the industry is aware of a credit loss. So it's a pretty safe proposition for people.
Yeah, that's interesting. I mean, obviously, paying 90 cents on the dollar, is there a timing difference? If you have to buy a credit now, is it applied after the end of the tax year? Is there a holding element to it, or how does that work?
And that'll vary by credit type and by state. Some credits can be bought retroactively. There are a few that can be used retroactively, while others, almost all of the allocable credits have to be acquired before the end of the year, because you have to be a member of that partnership as of December 31
Sure.
to receive an allocation from that particular year of the partnership. There's some that don't, but that's a crazy world for that to happen. But that is the way it works in Missouri for some credits. And then many of the freely transferable ones can be done retroactively. It just depends on the state statute or the federal statute that's involved.
Okay, so there might be a very small waiting period or time delay between buying it and be able to use it, especially if it's a retroactive one.
Correct. There, it's almost instantaneously. A lot of the other credits are basically bought and sold or acquired in the second half of the year. So the buyer can. It doesn't matter when the buyer gets them. When the buyer gets them, they can immediately make an adjustment to their estimated tax payments. So they can get the benefit of those credits immediately.
So, what are the sizes of these types of deal? Let's take a typical tax credit deal. These aren't $100. Are they? What's the typical range and size of these?
Well, there is no one. Well, the range would be. I guess we see them anywhere from 100,000. Up to in the tens of millions. For some of the federal credits can go as high as 100 million to a purchaser or acquirer. But normally we see at the federal level, we see orders in the range of 5 to 10 million on up. At the state level, we see orders from corporations in the range of 100 to 500,000 on up. It's not unusual to have orders in the low millions as well, but it just depends on the size of liability that a company would like to address.
Sure, and if the typical lift is about 10%, that can be interesting. Excellent.
Yeah, some of the margins on the typical lift on the federal is a little north of 10, and then the on some of the it depends on some of the state credits. The lift is, maybe below 10, and then others that are 15 or 20. So it just depends on the kind of credit, the volume of demand, and how long that credit has been around. Obviously, the ease of typically the state credits with greater margins returns are the ones that involve the partnerships. The ones that don't involve the partnerships, because they're easier to implement, are tend to have the smaller margins.
Excellent. Thank you, George.
No problem. Enjoy.